Okay, we're going to go ahead and get started here. This is a 1031 exchange class, so we're talking about deferring taxes. And the whole idea, of course, is if you're selling an asset, it doesn't have to be real estate. It could also be personal property that you own in your business. But the idea is if you're selling an asset, you're going to buy another asset of like kind, you can do so without paying any taxes. It's tax deferred. And the concept is if it's tax deferred, all of your money stays working for you. Therefore, you can build your net worth, build the value of the properties, build your cash flow, etc. And that's what we're trying to accomplish. So, of course, 1031s is what we'll be talking about. That's investment property. So we'll dive into that in a lot more detail. 1033 exchanges is where a lot of people have either never heard of it or have never done one before. And the 1033 kicks in one of two scenarios. One is eminent domain, or condemnation of property. So a city, state, federal government condemns your property through the eminent domain procedures. Or the second is a natural disaster. Fire, flood, hurricane, etc. And if either of those occur, you could do a 1033 exchange and defer your capital gain taxes and defer your depreciation recapture taxes into the property that you acquire. The benefit with a 1033 is you have 2 to 3 years to reinvest instead of 6 months for a 1031 exchange. So there's a lot more planning opportunity, especially if you have property that's difficult to replace. So you might want to look at the 1033 if you qualify. You don't need a qualified intermediary, or we call it a QI. So in a 1031 exchange, you have to have a qualified intermediary or an accommodator hold your funds to prevent the triggering of constructive receipt. In a 1033 exchange, you don't have to have an accommodator. So in an eminent domain, the government agency tells you as the investor what your property's worth. Whether you disagree with it or not is a whole different issue. And they give you a check, take your property, and it's what they call as an involuntary conversion. It's obviously involuntary on your part. If that's where you stop, it becomes a taxable event. Or you can take the check and turn around within 3 years and reinvest in a like-kind replacement property, and it's tax deferred under 1033. With a natural disaster, it's typically, fire, flood, hurricane. It may wipe out all or a portion of your property, and with that as the case, you'll get an insurance check, your insurance proceeds to reimburse you for your loss. It's also an involuntary conversion. And with that, you have 2 years to either rebuild the property that was destroyed or buy another like-kind property. So 2 years for a natural disaster, 3 years for a actual eminent domain process. Any questions on that as far as eminent domain goes? Or?
I'm representing a seller who's got a gas station in Rialto, and he thinks he can qualify for the eminent domain because the city has said they consider eminent domain property. Just by the city saying that, is it fall in that category?
Absolutely.
A court order or a judge saying that eminent domain has been identified at that location?
All it takes is a threat.
Right on now.
Now, the tough part is how do you prove the threat? So if it's a verbal threat, it's a little sketchy because the city can come back later and say, no, I didn't really say that. So in fact, do you know where they're at? Have they negotiated a contract yet?
He's looking at offers to sell.
Okay. I would actually have him build that into the contract, that if he decides to voluntarily sell to the city, you can include language that the city essentially is saying, we're buying the property from you. If you refuse to sell to us, we're going to condemn it. And that would qualify.
The city wants him to sell because they don't like his current use. I'm sorry to
Oh, sure. No problem.
But he's selling to another buyer. He's not selling to the city.
It would have to be a threat of condemnation or threat of eminent domain in order to qualify. If the city is forcing the sale for any other purposes, or if they're forcing the sale under a different part of the code, whatever the code might be, environmental issues, use issues, etc., then it wouldn't be a 1033. It would have to be an eminent domain threat in order to qualify. And they may be willing to put that threat into the contract or in a letter, maybe a letter from the city that if you don't do this transaction, we will condemn the property. So if it's a threat of condemnation, it would qualify. And the city may not realize that. So if your client turns around and says, look, if you provide a letter to my client that says, I'm going to threaten you with eminent domain, and if you refuse to sell and whatever the transaction is, we will take the property through eminent domain, that letter is extremely valuable. that alone will get you what you want to accomplish. Which brings up a good point. Why do we bring up 1033 exchanges? In most cases, clients don't want to have to wait 2 to 3 years to reinvest the property. That's money sitting around not doing anything for 2 to 3 years. The reason we bring it up is a lot of times you've got a regular transaction. It doesn't look like a condemnation, but it could be converted into a 1033. And so if the buyer is a government entity, or in your case where the city's kind of rattling their saber, if the city can just threaten to condemn the property, it qualifies. So, especially with clients that have property that has very specific use, would be very difficult to replace the property. The 2 to 3 years might be a gold mine in terms of timing. So, there's a lot of reasons why you might want to take the 1033 and put that into place. From a financial and tax perspective, the 1033 is identical to a 1031. Everything is tax deferred, so there's no tax consequence. From a financial perspective, we're going to talk about that in a 1031 context, where you essentially have to reinvest everything, and we'll define that later. With a 1033, you don't. The only requirement is you trade equal or up in value. So if you have a $3 million property condemned, you have to buy $3 million or more. It's a great way that if they have a lot of cash trapped in property, they can get the cash out through a 1033 without paying any tax. With a 1031, you'll find that really the only way to pull cash out is through a refinance transaction. So you've pulled the cash out, but you still have debt that you have to service. So with a 1033, you don't have to replace any of your equity. If you could finance it 100% if the lender would go for that. So it's a great way to pull some cash out and not have to worry about debt or any kind of taxable event. 1034 exchanges actually were repealed, so they no longer exist. They were repealed in 1997. The 1034 exchange was the old, actually it wasn't really an exchange. We call it a 1033 or 1034 exchange because it's part of the tax code. It's section 1034. It's actually the old rollover provisions for the sale of your primary residence. So if you owned your primary residence, you sell it, you had 2 years to reinvest, and all you had to do is trade equal or up into a new primary residence. It was a rollover provision. Your capital gain was rolled over to the new property. So it was just tax deferred. That was repealed and replaced with section 121. The 121 is actually a better mousetrap. It's tax-free. And if the taxpayer has owned the property and lived in the property, so you have to own it and live in it for 24 months out of the last 60 months, so 2 out of the last 5 years, and it doesn't have to be consecutive. It can be 12 months as a primary, 12 months as rental, then 12 months again as primary residence. So for a total of 24 months out of the last 60 months, when they sell the property, they can exclude up to $250,000 in capital gain taxes if it's an individual, $500,000 if it's married. It's really $250,000 per investor, per taxpayer. It's tax-free. The problem is in Southern California, we have a lot of people whose capital gain exceeds $500,000. So that's the tough part. So as soon as I'm done here, I'll show you how you can combine the 1031 exchange with the 121 exclusion and address that problem. We have highly appreciated property. But if your capital gain is less than $500,000 and you're married, sell your primary residence, not a problem. It's all tax-free. 721 exchange. Has anybody heard of the 721 exchange? Nope. Okay. 721 has a lot of nicknames. So the purest form is a 721 exchange. You're also going to hear it called a 1031 721 exchange. And probably the most frequent nickname is what they call as an upREIT. And the UP stands for Umbrella Partnership. So it's an upREIT, and the UP is Umbrella Partnership. Some people refer to it as an operating partnership. Let me first describe what a pure 721 exchange is, and then we'll go into what's really common today. It's actually not that common. You don't see too many of these done. But if you do, you're going to see a combination as an upREIT. But a pure 721 exchange means I'm going to give my property, by deeding my property to a REIT, a real estate investment trust. And in return, they're going to give me an ownership position in the REIT. So I haven't sold my property and then turned around and bought shares of stock in a REIT. I've exchanged directly with the REIT. That's the pure 721 exchange. And literally, I give my property in return for an ownership position. The problem with that is if I have a 10-unit or a 20-unit apartment complex, the REIT's not excited. REITs typically want 500-unit apartment complexes, or a $50 million or $100 million commercial office building, and they're going to buy, with a pool of capital they raise, they're going to buy 30, 50, 60 different commercial properties. So my 20 unit is kind of a joke in terms of what the REIT is looking for. So what you see is the up portion come into play. It's a combination of a 1031 exchange first at the front end, followed by a 721 exchange. The way it happens is I sell my 20 unit, I structure it as a 1031 exchange transaction, and I buy a fractional interest in property the REIT has picked out. So the REIT might say, we're buying this 500-unit apartment complex. I sell my 20 unit and I buy a 2% interest in the property the REIT has chosen. And I'm going to own that for anywhere from 12 to 24 months. It all depends on the REIT. But usually it's 12, 18, sometimes as long as 24 months. So I do a 1031 exchange, sell my 20 unit, buy a 2% interest in their property, hold it for 12 to 24 months. That holding period is critical. You want to be able to say you had the intent to hold that 2% interest for investment purposes. So they're always going to have you hold it for 12 to 24 months to prove you held it for investment. After that, then the entire property is contributed into the umbrella partnership. So that 500-unit apartment complex now becomes part of the umbrella partnership, which is controlled by the REIT. That's the 721 portion of the exchange. There's positives and negatives for this transaction. Depends on what you're trying to accomplish. Positives are you get out of real estate. You're now in a REIT, which owns lots of real estate. So you're better in terms of diversification strategies. It's more liquid. Typically, the REIT is not public, but will go public. So now you have something that's publicly traded. You just call up and you convert the REIT. You convert your partnership interest to the REIT and sell it on the open market. So there's more liquidity involved. The downside is once you've done this, you no longer own real estate, so you can no longer do a 1031 exchange. So essentially, you're trapped in the real estate investment trust. You get a step up in basis. So when you pass on, the value of your shares in the REIT still gets stepped up, and we'll talk about that later, but that still applies. It's got some estate planning characteristics. One of the problems you hear with families is, I have a large apartment complex. When I pass on, how do I divvy it up between the kids? I have 3 kids, they're all going to fight over it. If you do this transaction, you end up with, let's say, 1,000 shares. You can determine how many shares each kid gets. Or if you want, you can always sell off 100 shares this year because you had a bad year, you don't have a lot of taxable income. You can choose how many shares to sell and when to trigger your capital gain tax. So a lot of planning opportunities depending on what you're trying to do. We see very few of these in today's market because 1, you're stuck, you can't get back out and get back into real estate, and 2, we'll talk about TIC properties later on, but when TIC properties came out, it's much better a mousetrap, so you see a lot fewer of the upREIT transactions. Okay, 453 is the Installment Sale Code. And we haven't seen a lot of these in the last 3 or 4 years, but they're beginning to surface again. The ugly heads are popping up. So essentially what it means is you sell real estate and you carry back a seller carryback note to help the buyer finance the acquisition of the property. So it's a seller carryback note. There's pros and cons with the seller carryback. It all depends on the client themselves, what they're trying to accomplish, and what their end game is. If it's a pure installment sale carryback, that means you sell real estate, you carry back a note, and you're not going to do a 1031 exchange. It's easy. The installment sale is taxable as principal payments come in. So it is tax deferred to a certain extent. So kind of as an extreme case, let's say that you sell $1 million property, you do a 100% seller carryback, which is unusual, but you finance it 100% for the seller, or for the buyer, excuse me. And it's a 10-year note, interest only. So it's a balloon payment due in 10 years. Your entire capital gain is deferred into the 10th year. And when the payment's made and all that principal comes in, that's going to trigger the capital gain tax. So it is deferred to a certain point. The only thing it will not defer is depreciation recapture. So if you sell property in 2007, with a 10-year note, it's going to be deferred for 10 years, but your depreciation recapture is taxable this year. So we want to take a look at the property. If you have a huge position as far as deferred depreciation, it could be a big mistake to use an installment sale carryback. Okay, the other structure for an installment sale is to include that as part of the 1031 exchange. So the first method I just outlined is excluded. It's not part of your 1031 exchange. What we see today is they sell property, they intend to do a 1031 exchange because they want to defer all the taxes. The problem is they did a seller carryback note and didn't ask anybody if that would cause any problems. So by the time we get involved as an accommodator, we find that it's in escrow, it's going to close in 2 weeks, and there's a seller carryback note. So the taxpayer then has to decide, am I going to do an exchange on the entire process, including the seller carryback, or am I going to exclude the seller carryback and treat that as separate? So if you exclude it, then all the cash goes to the accommodator. That's all part of your exchange. The seller carryback note is outside of the exchange in the taxpayer's name, and it's taxable as I just described. If the taxpayer wants to defer all of their capital gain taxes, including depreciation recapture, then this has to be inside of the 1031 exchange transaction. And the way they do that is at the close of escrow, it's critical. The escrow officer has to put the beneficiary on the note and the deed of trust as the accommodator. So the accommodator owns any cash that comes out of the close and is the named beneficiary on the note and deed of trust. That's critical. If they accidentally put the taxpayer's name on the note, there is no way to undo that. Once the escrow closes and the deed of trust records, it's a taxable deal under the Installment Sale Code. But if it's all included under the accommodator's name, then it's all part of the 1031 exchange. That's the easy part. Structuring it is the easy part. You put it all in the 1031 exchange. The wire transfer is sent to us as the accommodator. We own the note and the deed of trust. The tough part is how do you convert that note to cash in order to buy your replacement property, because now you've got 45 days to identify, 180 days to buy your exchange property, and if you can't convert it to cash to buy your replacement property, there's nothing you can do about it. So that's the tough part. There's 3 solutions to that issue. You can sell the note, and typically that's pretty expensive because you have to sell it at a discount. Discount rates are pretty expensive. You can offer the note as consideration for the property you're buying, so you can assign it to the seller of your replacement property. Most sellers are going to tell you where to go. It's not an option. Or the taxpayer can come in with cash and put cash into the exchange equivalent to the carryback. So if it's $1 million seller carryback, they put $1 million into the exchange account. That's what they call boot paid. They paid $1 million into the exchange, so it's boot paid. At the end of the 1031 exchange, when it's all complete, they bought their property, escrow's closed, we assign that note to the taxpayer. That's boot received. It nets out to 0, so there's no taxable event. People call it buying the note out of your own exchange. You're really not buying the note. You're really contributing cash, and then you get the note at the back end. The only thing that's taxable is the interest income on the note going forward. Everything else, the capital gain, depreciation, recapture, is left on a tax-deferred basis inside the exchange account.